Hi there. LTCG, this four-letter acronym is finally a reality. So we thought it's a good time to really get comfortable with it and understand how the long-term capital gains tax regime is going to kick in and how it is going to impact your share transactions. So very simple. We've taken a very, very simplistic example to illustrate the point. Keep three things in mind. The purchase price in our example is the price at which you originally bought the share. We've taken that as 100 rupees. What is the cutoff price? That is the January 31st, 2018 deadline, or the cutoff line, which the finance minister outlined. That is the point from where all your old capital gains get grandfathered. It is a very, very important cutoff line. The selling price in our example is a whole 1 year later. So you bought in May 15, 2017. You're selling a whole year later in 2018. And let's say you're selling at a price of 250 rupees. The number of shares for our example, 2,500, and note very carefully over here that in this case the cutoff price 200 rupees is higher than the original cost at which you acquired the share, which was 100 rupees. Now let's move forward and take a look at how this is really going to play out. Very simple rule you need to keep in mind. Whenever you are calculating the amount of capital gain, you always need to consider the higher of the two, the cutoff January 31st or the original price at which you bought the share. Now in the example that we have taken, the cutoff price is higher than the original cost of the share, the price at which it was originally bought a year ago. So let's go to the numbers and really see how now this is playing out, how the math is really working. Capital gains on a per share basis in this case is going to be 250 rupees because we sold at 250 minus the price on the 31st of January, and this is the highest intraday price. What was the highest level the share touched that day? In our example, it's 200. So the per share gain is very simple, 50 rupees. So that part is now taken care of. Important rule to keep in mind, the capital gains tax starts kicking in only when the gains exceed 1 lakh rupees. So that's a bit of a exemption of sorts that the finance minister has offered. Now let's go back and apply this rule to the numbers. So remember, the original number of shares was 2,500 and the gain per share is 50. What is your total capital gains? 1,25,000. However, the good news here is that you get that 1 lakh exemption because gains up to 1 lakh are exempt. So the actual price at which you will calculate the tax is only 25,000 rupees. The tax is 10%. So we know what that means, that the actual tax liability is going to be 2,500 rupees. That much is quite simple and clear. Now, there will be several cases that arise, depending on whether the cost price is higher or the selling price is lower or, what the cutoff date and the cutoff price is. Let's analyze a couple of these scenarios. First case, where the buy price is lower than the 31st of Jan price. This is very simple, similar to the example that we just did. So, for instance, your buy price was 100 rupees. The cutoff price is 150. So, we need to keep the cutoff in mind. The selling price is 200. Subtract 150 from 200, your capital gains comes to 50 rupees. Very, very simple and clear. Let's move to the next case and see how that is really going to play out. Here, the buy price, the original cost of acquiring the shares is higher than the 31st Jan price. So basically, the original buy price, that's what you have to benchmark your gains against. In this case, your selling price was 400. You need to subtract 300 from that because you can see 300 is more than 200, right? So your capital gains are 100 rupees. You simply take the higher of the two. Remember that and always keep that in mind. Let's look at the third case and see how it's going to play out in a different scenario. The selling price is lower than the buying price. Very simple. Where is the concept of a gain? There is no gain. You've sold at a loss. You've sold at 50 rupees. Originally, you paid 100 rupees for the share. There's actually a loss of 50 rupees. No case of any sort of a capital gains tax liability. Last but not the least, let's take one more scenario to sort of even this out. The selling price here is lower than the January 31st cutoff price. So here the buy price was 100 rupees. The January 31 price was 150, which means that's our benchmark. But look at this. What happened? That after the 31st of January, the share depreciated in value. It actually fell down to 110. Here, it's very simple. The difference between 150 and 110 is 40 rupees. So anyway, your tax liability is nil, even though you've made 10 rupees on that transaction from 100 to 110. But, for the purpose of calculation, you won't have to pay any tax. Those are the scenarios. That's how it's going to play out. Hope this has been helpful and hope you can keep your tax math in place when you're looking at buying and selling shares in this new regime.